Hello investors, welcome to the channel. For today's video, we're going to be going over the 4 months covered call or PMCC. Now this is one of the best option strategies out there, hands down. If anyone could show me better, then please do. Now, I'm going to show you how to use the PMCC option strategy in order to more than 10x your portfolio and then some. So, if you're new to options and you're looking for that single option strategy in order for you to consistently grow your portfolio over time, then you stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you the best option strategy I utilize in my portfolio in order for me to grow my portfolio consistently over time. And you can use this option strategy as well, especially if you're trading with a small account portfolio that you're trying to grow. Now, this option strategy involves two smaller option strategy in order for you to get that desired result that you're looking for. Let's go ahead and do what we're good at on this channel. Let's go ahead and get down and dirty with options. For today's option video, we're going to be using none other than AMD Advanced Micro Devices. Now let's go ahead and get right into your option chain like we usually do. Let's go to trade AMD options in order for us to open up our options chain. Okay, so here we have our option chains open. Now I need you guys to do me a huge favor. You know what? I need you guys to do me two huge favors. Number one is gonna be always do your own due diligence before investing in any option strategy. But even more important than that, always make sure you have an exit strategy before entering any trade. That being said, when doing the PMCC or Commerce Covered Call, you will need to have a higher access level of options trading. If you train with Robinhood, you will need to have a level 3 or higher options trading. Now, here we are on the option chain, and like I said, the PMCC consists of two other option strategies. Let's go ahead and get started on the first option strategy. That first option strategy is going to involve you buying a long call. So in order for you to accomplish that, you're going to have to go ahead to buy and call, and now we're going to choose our strike date. The strike date for this needs to be far out, and for my personal preference, I like to go about a year out. Now, in order for this strategy to work, you could go anything from 3 months and beyond. It all depends on the second leg of the strategy, what you have planned in mind. Now, so now that we're going to go about a year out and we have already selected buy and call, now we're going to go ahead and choose our strike price. Now, with the PMCC, you could choose a strike price in the money or out the money. Now, if you don't know what that is, let's make it simple like we do on this channel. To make this option strategy as effective as possible, it's highly advisable that you choose your strike price below the current share price. As you can see here, the current share price is trading at $109. So let's go ahead and we're going to choose a strike price right below that. And I will be going with the $90 strike price right here. As you can see to the top, strike price. Now, this $90 strike price here may look random, but it's not. I guarantee you it's going to make sense as the video goes along. Now, we're going to go ahead and check out what's called our break even. Now, the next column right next to strike price is break even. So our break even is going to be around $129. Please remember that number. I will revisit it twice in this video. Now we're going to go ahead and take a look at our delta. Our delta is going to be 0.8. Now, when buying a leaps option, my personal preference, I like a delta of 0.75 or more. And once again, that's going to depend on your own risk tolerance and the particular stock that you trade in. Now, because we're going to be buying something, we're going to have to pay in order to acquire it. The amount we're going to have to pay is going to be $40 a share. That's going to work out to $4,000. Now, the reason that's going to work out to $4,000 is because each option contract is multiplied by 100 shares. So 100 multiplied by $40 will net you $4,000. We're going to go ahead and we're going to hit continue. When buying a leaps option, it's highly advisable that you put in a limit price. This is not like buying a cash secured put or a covered call where you make $20 and $30 on a consistent basis. This is actually $4,000 of your money. So please always enter your limit price. So we're going to use the exact same limit price that's here, which is going to be 40. And there you have it. So we agreeing to pay $4,000 in order for us to pick up a long call on AMD that expires January 16th, 2026. Once again, this is known as a long call or a LEAPS option. LEAP stands for Long-Term Equity Anticipation Securities. Now, before we get into the second leg of this option strategy, I want to answer the question, why would anyone want to buy a LEAPS option or a long call? Well, it's quite simple. The mindset that goes behind purchasing a LEAPS option is that the stock is going to go up in the long run. The reason why you're going to buy a LEAPS option is a couple of things. One, it allows you to get an expiration date far out, which gives the stock enough time in order for it to do what you want it to do, and that's go up. With the American Stock Exchange, it usually goes up over time. The next advantage of purchasing a LEAPS option is that the price at which you get it. It allows you to control 100 shares of a stock and do whatever you want with it, as well as getting your stock appreciation. Now, when doing any options contract, you need to do two things. You need either to purchase 100 shares of a stock, or you need to be able to control 100 shares of a stock. So if you were to buy 100 shares of AMD right now, you would have to pay $109 per share, which is going to work out to be $10,900. If you're trading with a small portfolio, that's not very likely. Most of your portfolio will be caught up in just this stock. If you choose the route of buying a LEAPS option, now you're only paying $4,000. So that is one of the benefits of owning a LEAPS option in your portfolio. Now, if you guys are getting any value from this video so far, go ahead, like the video, subscribe to the channel, and most importantly, hit that notification bell to get an alert when I post a video. Now that we have a LEAPS option in our portfolio, now we're going to go ahead and do the second strategy that I mentioned in this video, which is going to add up to the PMCC or Commands Covered Call. Now we're going to go ahead to sell and call, and now we're going to choose our strike date. In this instance, our strike date needs to be closer. It does not need to be an entire year out. And we're going to be going with February 14th, which gives us 10 days to expiration. Now, as opposed to the LEAPS option you just picked up, now we're going to be choosing our strike price above the current share price. Now, did you guys remember that little break even I showed you a second ago? Well, this is where it comes in handy. So the break even on the Robinhood literally tells you that when you're selling covered calls against your LEAPS, this is actually the price that you should go minimum. So your break even was $129. So it's actually telling you do not sell any covered calls lower than $129. You will be losing money. And that's the importance of your break even. Now I'm going to show you a simple rule of thumb. A simple rule of thumb for doing the PMCC is that you need to make sure your deltas are equal to 1. Now, if you remember, when you bought your long call, your delta was 0.8. Now you're going to be selling covered calls. Your delta should be 0.2 or lower, which is going to equal to 1. And there you have it, 0.2. 0.2 plus your 0.8 is 1. Now, on this channel, I usually teach people how to be extremely conservative while still making a decent premium. So although any price around 29 is good, I like to be extremely conservative, and I'm going to go up and choose an even higher strike price. Now I will be going with the $136 strike price, and that's going to give me an 86% chance of profitability, meaning that there's an 86% chance that this trade works in my favor, which is the covered call. Now, for using my LEAPS option and putting it at risk in order to sell a covered call, I must be compensated. The compensation I'm going to be receiving is going to be $1, or once again, it's going to be $100. $1 multiplied by 100 contracts. Now, using your LEAPS option in your portfolio and then writing consistent covered calls, the two strategies together is known as the PMCC or Poor Man's Covered Call. Now, I'm going to go ahead and show you why the Poor Man's Covered Call is the best option strategy in my portfolio. So whenever you do a covered call on your LEAPS option, you get consistent premium. That consistent premium is yours to keep no matter how the trade goes. Now, let me show you how this trade could go. So the whole point of buying a LEAPS option is for you to keep the LEAPS option in your portfolio as long as possible while the share price appreciates. And that's going to allow your portfolio to 10x because there's no limit to the upside. Now, by selling a covered call, you're placing a limit on how far up it could go. Hence, I chose a very high chance of profitability, which is way above my break even. Now, come expiration date of February 14th, if the share price of AMD goes past our strike price here of $136, then it's going to be bad news for us because we're now going to be assigned on our leaps option. But it is not a bad thing at all. And let me show you why. If the share price does hit 136 or above at expiration date, then once again, we're going to now be able to keep our $100 of premium. Now, because we're going to lose our leaps option, mean we're going to be assigned, we're going to be making some additional money. The additional money we're going to be making is going to be known as stock appreciation. Now, here's the stock appreciation. Your covered call price is going to be 136 and your break even price was 129 if you remember correctly. What we're going to do is we're going to subtract the 129 from your 136 and that should give us about $7. Once again, each option contract is multiplied by 100 shares. So you're going to multiply your $7 multiplied by 100 shares and that's going to give you $700 return if you're assigned. In addition to that, you need to add your $100 premium. So just by doing this trade only, you stand to benefit and grow your portfolio by $800. I'm not sure about you, but if I were to get $800 on one single option strategy, I count that as a win for me and most importantly for my portfolio. Now that is a very simplistic explanation I just gave you because your gains are going to be way higher than that. So let me go ahead now and show you where your gains really going to be. So now we're going to go all the way down to the share price. Now, if you picked up your leaps option when the share price was trading at 109, your actual stock appreciation is going to be the difference between your 109 all the way up to your 136. And that's how much money you stand to gain with this, plus your premiums that you receive on a consistent basis. Now, one of the reasons why the PMCC is such an amazing strategy is that you get to choose a very high chance of profitability and make some decent premium. By making $100 on a weekly basis and keeping your leaps intact, you're able to make consistent income over time. And that consistent income is what helps you to grow your portfolio. Now, when is the best time to purchase a leaps option? Now, the best time to purchase a leaps option is not when the stock is falling. The best time is when the stock shows clear signs that there's a reversal and the stock is going to be going back up. The market usually have pullbacks. A pullback does not mean that's the time to get in. Have patience, wait for clear signs that the stock is going to be going back upwards, and that is your time to strike. So there you have it. The PMCC is one of the best option strategies there is out there. It is my favorite option strategy for a couple of reasons that I just showed you. In order for you to do the PMCC, you need to, first of all, buy a leaps option or a long call. Once you buy that leaps option in your portfolio, that allows you to control 100 shares of that particular stock. Once you now have control of that 100 shares of the stock, now you're able to sell regular covered calls against it to bring in premium. That regular premium is what's going to allow you to grow your account portfolio. Now, if you do get a sign on your leaps option, you do not have to worry. Always make sure you sell your strike prices for your covered call above your break even. Remember your break even. Hopefully, guys can do some more research on the PMCC and decide if it's a strategy that you want to add into your portfolio. So, thanks for watching. Go ahead, like the video, subscribe to the channel. But most importantly, if there's someone out there struggling to grow their small account portfolio, feel free to share the video with them. On this channel, we try to help as many people as possible grow their small account portfolio. And until next video, keep pushing your investments.